Hello everyone, in this video I will talk about chapter number 3, which is accrual accounting concepts. Now, in order to understand the accrual accounting concepts, we should know what is cash accounting. So cash accounting is the accounting method wherein the revenue is recognized whenever the cash is received and expenses are recognized whenever the cash is paid. It is not in accordance with the generally accepted accounting principles because it does not comply with the matching principle. Now, talking about who uses cash basis of accounting, usually it's used by sole proprietors or small companies. Now, let's talk about the accrual accounting. Accrual accounting, in accrual accounting, the revenue is recognized when it is earned, means when the work is substantially done. So the accrual accounting is different from cash accounting because in accrual accounting, cash is not important. As in cash accounting, cash was the most important thing. Whenever the cash is received, the company will record revenue. Whenever the cash is paid, the company will record expenses. That is cash basis. But in accrual accounting, the cash is not important. The transactions are recorded in the periods in which the event occurs. So the event is important in accrual accounting. The revenue are recognized when the services are performed, even if the cash was not received. And the expenses are recorded or recognized when incurred, even if the cash was not paid. So the accrual accounting is actually based on the matching principle. Let's review what the matching principle means. Matching principle requires that the companies match expenses with revenues in the period when the company makes an effort to generate those revenues. Okay, so now there is something we want to talk about is adjusting entries. Adjusting entries are not done in cash basis of accounting because it is just keeping track of the cash in and out. But in accrual accounting, adjusting entries are required to prepare the financial statements. Let's talk about adjusting entries. Adjusting entries are usually made on the last day of accounting period. Accounting period can be a month, a quarter, semi-annual, yearly. So whatever period for which you are doing the financial statements, the adjusting entries are made on the last day of that period, just before doing the financial statements. These entries are made so that the company's financial statements comply with the accrual method of accounting. This adjustment process is necessary to match revenues and expenses. In other words, adjusting entries are needed so that the company's income statement report revenues that have been earned and expenses that have been incurred during the accounting period. And the balance sheet reports the receivables for amounts that it has the right to receive and liabilities for the amounts that it has incurred. The adjusting entries ensure that the revenue recognition and expense recognition principles are followed. Adjusting entries are required every time a company prepares the financial statements. And the adjusting entries include one income statement account and one balance sheet account. Important thing to keep in mind is that in adjusting entries never involve cash. That is why the adjusting entries are never done in the cash basis of accounting, because they do not involve cash. Whenever there is an entry that has cash, it means that it is not an adjustment. Now I want to do one example of some of the transactions, um, both ways, with the cash accounting method and accrual accounting method, so that you can see the difference. Okay, so I have an example, small example, with just three events, three transactions. So it's a magazine company, and the first one is, first we are going to use the cash accounting method. Okay, so this is a magazine company, and the company received advance fees from 50 clients for yearly subscription. Each client sent a check of $1,200 on January 15. Now it's important to keep the dates. So we are doing cash accounting, and it is January 15. Okay, and the company received cash of 60,000, so the company increased cash. Now in cash accounting, whenever the cash is received, it's revenue, so the company will increase the revenue 60,000 on January 15. Now just see over here what's going on. These cash that the company has received, it is for the yearly subscription, means it's for the whole year, but they have recognized it as soon as the cash is received. Okay, and on second one is, now this was first, the second one is, company pays its electricity bill for previous month on the 15th of next month. January bill was paid on February 15. So it is February 15, and the company is paying the cash. So whenever the cash is paid out, it's recognized as expense. So expense was 1,500 and cash was paid out 1,500. Let's do number 3 also. Company has 4 employees. Salaries are paid quarterly, every 3 months. Monthly salary of each employee is $1,000. Client paid employees for January, February, and March on March 31st. Next entry was March 31, and that is also expense because they are paying out. So the total expense was $12,000 for 3 months for 4 employees, $1,000 each. So $12,000 they paid to employees, and the cash went down by $12,000. Okay. Now, if this with the cash accounting, if the company had to prepare the financial statements monthly, okay, monthly. So if they are closing their books on January 31, what will be on their income statement? 60,000 revenue, no expenses. What if they close their books next month on February 28? They will have expense of 1,500, no income, so means their net loss will be 1,500. March 31, again they will have an expense of 12,000 and no income, because all the income was recognized in January month. Okay, so this doesn't give very clear picture of the of company's financial position. If somebody just want to see February financial statements, they will have expenses only, no income, so the company will show a loss. Okay, now let's try to understand what will happen if the company uses the accrual accounting. Okay, now same transactions, but now the company is using accrual method. So the company received, again the first one is on January 15, they received cash, they will record cash. Okay, 60,000. But now they will not recognize the whole revenue. They will put that in the liabilities because they haven't um served the clients yet. So it's a liability on the company. So the company will create an account, unearned revenue 60,000, means on January 15 nothing is earned yet. They haven't earned the revenue yet, so they have postponed the revenue recognition. So it will sit on the balance sheet as unearned revenue. Okay, now let's say that it is January 31 and the company wants to prepare the financial statements. Okay, now on January 31, company needs to do adjusting entry. Why? Because some part of this 60,000 is earned now. For 1 month they have served the clients. The clients have used 1 month of subscriptions. Okay, so I think it's 5,000. Don't go on my math, but let's say that it is 1200. So the company has recognized 6,000 of 5,000 of this 60,000. So what will they do? They will debit the liability. So unearned revenue 5,000, and now they're recognizing the revenue, so which will go on the income statement, revenue 5,000. So first the liability was increased and now the liability is decreasing on January 31 and they are recognizing the revenue. And just see that this adjusting entry does not involve cash. Okay, now let's look at the second one. The company pays its electricity bill for previous month on 15th of the next month. January bill was paid on February 15. In accrual accounting, does not matter when the bill was paid. The bill was for January month. Okay, that $1,500 was for the expense for January. So doesn't matter that they're going to pay it in February, but on January 31 they will again do adjusting entry for this January bill. What will they do? They will say electric expense 1,500, means they are recognizing the expense which will go on the income statement, and they will incur a liability, accounts payable 1,500. Now when February comes and they pay the bill, then they will debit account payable and credit cash. Okay, let's look at the third one. Company has 4 employees. Salaries are paid quarterly every 3 months. Monthly salary for each employee is $1,000. Client paid employees for January, February, March, and March 31. Now even though they are paying it on March 31, but they have to record the expense for 1 month for January before closing the January books. So what they will do is they have 4 employees, $1,000 each month. So they have the expense again on January 31. Another adjusting entry is that they have to record this expense because this expense belongs to January. So they will record wage expense 4,000 and again wages payable 4,000. So whenever they will pay these wages, they will debit wages payable and credit cash. Okay, so these are the adjusting entries that they will do at the end of each period. Now this next slide shows whatever I did it with my hand on the previous slide for cash method. For the cash method, this is for the cash method, and I think the next 2 slides are for accrual method. This is for accrual accounting. So it shows January, and then these three are the adjusting entries. You can take the snapshot of this and review them with the problem. This also shows the February. Again, they paid the electricity bill, and then they also did the adjusting entry for before closing the books, and again they did it for March. So you can take a screenshot, and then you can let's review the adjustment process again. Adjustment process is necessary to match revenues and expenses that have been earned and incurred during the accounting period for which we are preparing the financial statements. There are adjusting entries that are done, and the adjusting entries ensure that the revenue recognition and expense recognition principles are followed. There are two types of adjustments: deferrals and accruals. What are deferrals? Deferrals are created by recording the transaction in a way that delays or defers the recognition of expense or revenue. Now here defer, we are not referring to deferral of money. You are referring to deferral of recognition of expense and revenue. Okay. And the example is prepaid expenses. We will do some examples later on, but let's first review what deferrals mean and what accruals mean. So accruals are created when the revenue or expense has been earned. Accruals are created when revenue and expense has been earned or incurred but has not been recorded at the end of the accounting period. Okay. Again, deferrals are created by recording the transaction in a way that delays or defers the recognition of expense or revenue. Example are prepaid expenses, unearned revenue, office supplies, prepaid interest, prepaid advertising. Accruals are created when revenue or expense has been earned or incurred but has not yet been recorded at the end of the accounting period. Okay. So let's say you are in the current period and there is a time lag. This is the future period. When do deferrals occur? When the cash is received first. Okay. And the revenue is earned in the future period. The cash is received in the current period, but the revenue will be earned in the future period. Same way, the cash is paid upfront, but the expense will be incurred in the future period. That is deferrals. Okay. What happens in the case of accruals? In the accruals, the cash comes later. Okay. So in accrual, the revenue is earned before the cash is received, and the expense is incurred before the cash is paid. So the main difference is that in deferrals, cash comes first. In accruals, cash come later. Means the event occurs first and the cash comes later. Okay. So again, accruals means nothing has been entered in the accounting records for certain expenses and or revenues, but those expenses and or revenues did occur and must be included in current period's income statement and balance sheet. Okay, and accruals can be for expenses, accruals can be for revenues. Accruals of expenses means that the expense has been incurred and it has not been recorded in books. Examples are the wages. Okay, the employees have already given their services, but we haven't paid them, so we have to accrue this expense. Accruals for revenues means revenue has been earned. Doesn't matter if we have received the payment or not. Example can be interest income. We have earned it but not yet received. Okay, so again, let me repeat the definition of accruals. Nothing has been entered in the accounting records for certain expenses and revenues, but those expenses and revenues did occur and must be included in current period's income statement and balance sheet. Okay. Deferrals. Something has already been entered in accounting records. Something has already been entered in accounting records, but the amount needs to be divided up between two or more accounting periods. So they are already recorded in the accounting records, and now we have to make the adjustments. So deferral of expenses means that we have created an asset in balance sheet. Deferral of expenses, they sit on the balance sheet as an asset, like prepaid expenses, the expenses that we have already paid for. Like we have paid for the whole year rent, we have paid for the whole year of advertisement, we have paid for 2 years of insurance policy. Okay, so they sit in our balance sheet as an asset, and before closing the books for our accounting period, we will decrease that asset and record the expense for that period. Now, deferrals for revenue. Deferrals of revenue means that they sit on our balance sheet as a liability. Deferrals of revenue means postponing the revenue. It means we have earned something, we have received the money for something, but we haven't done our services yet. We haven't actually served the clients. If you look at the example that we did for cash and accrual accounting for the magazine company, so the company received the cash, but they haven't done the services yet. So that is unearned revenue. It's a liability. Okay. Notice that adjusting entries almost always involve a balance sheet account and an income statement account. Okay, like interest payable, interest expense, prepaid insurance, insurance account, insurance expense, accounts receivables, service revenues, etc. Okay, talking about the accounting for prepaid expenses. Prepaid expenses are deferral of expenses. They are like the asset accounts, right? The examples can be insurance, supply, advertising, rent, depreciation. The reason for adjustment of the prepaid expenses is that prepaid expenses are recorded as an asset account, and we need to adjust it because some part of it has been used in this accounting period. So before this adjustment, the prepaid asset account will be overstated. So, and the expense account will be understated. The adjusting entry for prepaid expenses will involve debit expense and credit prepaid. Expense. Okay, so that's going to be the debit entry. Now let me talk a little bit about the unearned revenue account. The unearned revenue account is a liability account. It means that we haven't earned the revenue yet, but we have received the cash. So cash is received before the revenue is recorded. And the adjusting entry is made to record the revenue for the services performed during the period and to show the liability that remains. Okay. The adjusting entry results in decrease means a debit to the liability account, and increase means credit to the revenue account. So the adjusting entry for unearned revenue account will be, it will be, now unearned revenues liability account, so with adjusting entry will be decrease into the liability. So it will be debit unearned revenue and credit revenue earned. Now let's look at some of the examples of deferrals and accruals that need adjustment at the end of the accounting period. Number one, fees earned but not yet received. So we have earned the fees and it's not yet received. Whenever the cash comes later, it's accrued. Okay, so now this is talking about the fees, so it's accrued revenue and asset. So it means the entry will be account receivable debit and credit will be revenue earned for the first one. Now second is taxes owed but payable in the following period. Remember, in accrual accounting does not matter when we pay. Now here we want to make the adjustment for the taxes that are owed, and we are going to pay them in the following period. So we are going to accrue the expense because taxes are expense. So in order to book the expense, we will say debit expense and account payable will be credit because we are going to pay it in the later period. All right, now let's talk about the third one, salary owed but not yet paid. Again, same as this one, it's going to be debit your wages expense and liability will be wages payable. Okay, supplies on hand, we have paid for the supplies first in advance and they are sitting in our balance sheet as an asset, supplies. Okay, so what we are doing is that we have created an account called, it's a deferred expense. So it means now we are recording the expense. So what we will do is, because we have used some part of those supplies, so we'll say supply expense, that is debit, and credit supplies. for the amount that we have used in the accounting period. Number 5 is fees received but not yet earned. We have received the fees. When we receive the fees, let's say it was on January 15 we received the fees. So what we did was, at that time what we did was, on January 15 we said cash, let's say 10,000, and unearned revenue 10,000, right? But now when we are closing the books, some part of it is being earned. Let's say we are closing the book on January 31 and we have earned some part of it. Let's say we earned $1,000. Okay, so we'll say unearned revenue 1,000 and revenue earned 1,000. So we are booking the revenue for 1 month. Number 6, utilities owed but not yet paid. Utilities owed but not yet paid. So the cash will be paid later on. So it's an accrued expense and we will record a liability on our balance sheet. Number 7, 2-year premium paid on fire insurance policy. So this is again deferred expense. We have paid it up front. We have already paid it up front. It's sitting in on our balance sheet as an asset. Okay. Subscription received in advance by the magazine publisher. Same example. So when we received it, we'll say cash is increased and our liability, unearned revenue, will increase. Okay, so these are all the adjusting entries, and make sure they are in the adjusting entries, no cash is involved. No cash is involved in adjusting entries. Now let's talk about this accounting cycle just briefly. So the accounting cycle, it's a term that describes the steps when processing transactions. Processing means we are going to analyze the transactions, we are going to post them in the journal ledger, we will prepare the trial balance, then we will do the adjusting entries, and then we will prepare the financial statements in the manual accounting system. So the most important outcome of doing all these steps is to prepare financial statements. Okay. Today, many of these steps occur simultaneously when using the accounting software. So let's look at the diagram. First, we identify and analyze the transactions. Then we record the transactions in the journal in the chronological order. And then we post the journal information to the ledger. After that, we prepare unadjusted trial balance, means whatever the account balances are on the ledger, they show up on the trial balance, but they are not yet adjusted. So we before doing our entries, before preparing our financial statements, we will do the adjusting entries. Okay. And then we will prepare the financial statements. So that's just the accounting cycle. Okay. There are more steps involved. After preparing the financial statements, we will do the closing entries, and then we will do post-closing trial balance, and then reversing entries. We will learn about all this in our later videos. But for now, just make sure that you are clear about the adjusting entries. There are two kinds: deferral and accrual. Deferral for the expense and revenue, and accrual for expense and revenue. Deferral means the cash is received or paid first and the event occurs later on. Accrual means that the event occurs first and the cash will be received or paid later on. I hope this video helps you. If you have anything you want me to improve on, please leave some comments. I'll see you in